Okay, dear student, this is Mustafa Mirchawala, your SBR trainer. And today we are going to do one more webinar for September 2023 attempt. And again, we'll be doing one latest past paper, that is March, June 23 attempt, right? Okay. So this question is also available on accaglobal.com. You can access this question from there as well. Plus, I can send you the PDF as well, right? Okay. So be confident. It's all about IS, IFRS, and practical issues. It contains like IS 37 and IS financial instrument and IS 7's SOCF statement of cash flow, right? Okay. So not that much difficult. Yes, there are little bit new things. That's usual in SBR, right? Because I've said this many times that get ready for some new things because you have to give your suggested solution. You need to give your suggested solution in SBR, right? Okay. So we are starting it. It says Fernando, it's question number 3, right? Of it. Fernando Companies is the parent of the group which construct industrial properties, right? This is their primary work. Fernando Company is currently preparing the consolidated financial statement for the year ended 31st December X7. Okay, be careful. It's not about individual books. It's about consolidated books. Now, what are the issues? The issues are exhibit number 1 is roof collapse. It's about IS 37, describes the potential liability for roof collapse. Exhibit number 2, it's about financial instruments, right? And exhibit 3, it's about cash flow issues. It's about IS 7. It's about IAS 7, right? Okay. So 3 things are tested. Let's start with the first thing. Fernando Company is a group which construct industrial properties in September X7. Now wait, your year end is 31st December X7. It's like 3 months before your year end. 3 months before your year end. Okay. This is September X7. A section of the roof of one of the building which it had constructed partially collapsed, right? Injuring 10 people. Okay, before the year end. Production which was taking place inside the building had to be stopped. Again, one more loss. However, now the game changer. However, no legal action had been brought against Fernando Company at 31st December X7. Biggest evidence. This is evidence. It's like case. So you need to pick evidences. So at year end, there is no legal obligation. No legal action has been taken. No legal action has been taken. So hope you remember IS 37 for provision. There are 3 conditions. And the first and the most important condition is present obligation. First and the most important condition is present obligation. So there are 2 types of present obligation. It's like legal and constructive. Obviously, there is no announcement by the company. There is no past practice. So don't think about constructive obligation. Plus, there is no legal action has been taken. Clearly, it is written. So that's why no legal obligation. So by taking this point, by using this point, you can say that there is no present obligation. And when there is no present obligation, you don't need to make provision. Okay. So let's move on. As accident investigators were still trying to find out the reason for the collapse. So it's under investigation. It's under investigation, right? There is no legal action against us. The investigators were assessing the responsibilities of the various parties involved with the roof expected with the report expected in February X8, February next year X8, right? Okay. So it looks like there are no probable chances of outflow, because right now they are not clear. The investigators are not clear that who is responsible for this. So how can they estimate the claims, right? Now, how come the probable chances? The extent of the damage and the details of any compensation payments to be made had not as yet been determined. See, so again, you cannot say it's probable chances because the damages of compensation has not yet been determined, right? Fernando Company felt that given the current state of the investigation into the accident, there was no there was no requirement to record any liability in the consolidated financial statement as at it's correct. It's correct. And yes, be careful with this thing. In SBR, this is the history of SBR, that sometimes they give you wrong treatment in the question and you have to challenge them. And sometimes, luckily, they give you right treatment. So you have to give green signal, right? So this time they are right. There is no present obligation, so there is no provision, right? Especially as Fernando company felt that any compensation payable would be covered by insurance. This is also one good point, that although there is right now, there is no obligation, but if there would be any obligation, it will be covered by the insurance company. And yes, there is an issue of netting off, which I teach in class, that they have not given you the details of insurance. Sometimes it happens that the other party sue you and you are responsible, and then you take from insurance company. So when the parties are different, you are not allowed to offset. When the parties are different, you can't do offsetting of receivable and payable. This is a separate issue. This is a separate issue which you are not allowed, you are not required to discuss here. But still, my dear student, this insurance thing also says that there is no problem. There is no problem. If there would be any problem, still the insurance company will pay, right? So after reading this, I can conclude that there is no provision at all. But yes, hope you remember there one word which we called possible obligation. In my lecture, I always teach at all levels, basic, advanced, super advanced, all levels. I teach this possible obligation. Possible obligation. Let me give you the definition. An obligation that arises from past events. An obligation that arises from past events. What is the past event? The collapse is the past event. An obligation that arises from past events and whose existence will be confirmed, whose existence will be confirmed by the occurrence or non-occurrence of one or more uncertain future events not wholly controllable for that organization. If you think about this definition, exactly this case is a possible obligation, but because it is under investigation. It is under investigation, and yes, if things goes against us, then we need to pay. If things goes against us, yeah, then there will be an outflow in future. So it's a possible obligation, and possible obligation normally leads towards contingent liability. But yes, there is a case. If there is a possible obligation, open your eyes, don't sleep. If there is a possible obligation and outflow chances is just remote, then in that case, you don't need to do anything. But yes, looking at this scenario, you just read this 7 lines. Looking at this scenario, you can see there is a big collapse. It's a big collapse, and the investigation is going on. And we were the people who constructed it. So we have seen many movies like this. So those who constructed, they are the primary party. Those who construct such things, they are the primary party, my dear student. So yes, we can say it's a possible obligation with possible chances. So it's better to include a contingent liability disclosure. Okay. As usual, in my last webinar, I have also told you that I'll give you just pointers. You guys have to send me this question. I need to mark your scripts. So you have to send me the solution. I'm just guiding you the few points that which will make your solution, right? Okay, just after this class, after watching this class, send me the solution. Send me the solution on my email ID, which I have given you, right? So it's a easy 7 marks we have. This is requirement number A. Discuss the acceptability of Fernando Company's decision not to record any liability for the roof collapse in the consolidated financial statement for the year ending 31st December X7, right? It's straight away 7 marks. It's a straight away 7 marks, right? Okay. So how to deal with it? I have written some pointers for you guys. First of all, state the rule. Normal. State the rule is what? you have to write the 3 conditions of provision. IS 37 conditions of provision: present obligation, probable outflow, the chances of outflow must be probable, and the third thing is a reliable estimate, right? Now you will say no present obligation at 31st of December X7 as no legal action. The whole story you have to say that there is no constructive obligation because there is no past practice like this and there is no announcement, plus no legal obligation as well. Why? Because there is no legal action has been started against us, just an investigation, general investigation is going on. So no present obligation means obviously no provision. Then investigators still assessing, also no probable chances of economic benefit as outflow not calculated. Even there no calculation has been done for damages. It was written in the question. We just went through that paragraph. So they have not yet calculated the damages. So no reliable estimate, even no outflow chance, probable chances. This is very initial stage. So definitely when there is no present obligation, no probable chances, so no liability at 31st December X7. Also one more evidence which we can collect. We are gathering evidence. I have said this many times in my lectures. SBR paper is like a court case. You have to collect evidences. So there is one. Also compensation payable to third party are insured. So we are also not responsible for paying anything. So why to book the provision? Okay, it's all insured. Now, after this, now you have to change the track. Yes, there is a possible obligation. Yes, there is a possible obligation. If chance of outflow not remote, if chances of outflow not remote, then contingent liability. There is a possible obligation. I have just told you the definition of possible obligation. If you want to write the definition, you can also write, but it's the word possible obligation itself is enough because I have just explained you. Now with possible obligation and the chances, if the chances are remote, then you should not do anything. Just leave it. But looking at the scenario, looking at the conditions I just told you, as we are the primary constructor, we constructed that building. So it looks like that chances are not remote, it's more than remote. Okay, so it's better to make contingent liability disclosure. Plus there is some uncertainties there because things are not done yet, right? But we cannot conclude outflow chances as remote, so it's better to make contingent liability disclosure. Okay, so this is all about the 7 marks. This is all about 7 marks here. This is all about 7 marks here, my dear student. And yes, you can score like 4 marks from this easily. I never say to score 100% marks. I say just score passing marks. That's it. That's our first priority. Now, let's move to the next part, which is financial instrument. Okay, now we have put option C, exhibit number 2. We'll first do the only one paragraph. Okay, on 1st of January X7, as a result of business combination, Fernanda company, the parent company, has written put options. Put option is right to sell. There is one thing which is called call option. This is put option. And I hope you remember in my classes, I have also discussed this putable instruments, right? That gives the other party the right to sell. And then when the other party has the right to sell, then we have to give cash anytime. Immediately we have to give. If the other party presses the button, then we have to buy it. We have to give them cash. We have to repurchase them. So it's an obligation. So it's put option. If you have given put option to somebody, if you have written a put option to somebody, then it's a liability on you. Be careful, think over it. To purchase the Company has written put option to purchase the non-controlling interest shareholding in a newly acquired subsidiary, Runda company, right? This means that Fernando company would be obliged to purchase the non-controlling interest shareholding in the subsidiary if the put options were exercised by the non-controlling interest shareholders, and yes, they can press button anytime. So it's about liability. And if you have attended the classes, I would openly say, if you have attended the classes, I always say in my class that standard is very sensitive for liability. Standard board is very, very sensitive for liability. They don't forgive. If there is a smell of liability in the transaction, you have to book the liability. So yes, if you promise somebody that yes, we'll buy our shares from you, we'll buy our own equity instruments from you, so it's a liability on us. It's a proper financial liability. It's like contractual obligation to deliver cash. Okay. Fernando company at 31st December, Fernando company disclosed a contingent liability in the consolidated. No, it's wrong. This is not a contingent liability. This is a pure financial liability. This is a real pure financial liability because you have written put option. Put option means right to sell. Put option means the other party has right to sell. And one more thing, think over it, please. In option, there is one thing which we call option. Option means choice. So in option, there are two parties. Party 1, party 2. Okay. Always remember that one party has choice and the other party is bound. One party has choice and other party has to do that. It's not possible that both parties has choice. Otherwise, in the end, they will fight. Just use your brain. So obviously, one party has option, choice. The other party has to fulfill it at any cost. So when we have written the put option, that means we have given right to sell to other party. And when that other party will exercise that right, then we have to pay them cash. So yes, it's a contractual obligation to deliver cash. And now, as in the question, be careful. On the first line, I have told you we are in the consolidated books. So consolidated books means the combination of parent and subsidiary. Consolidated books, don't sleep. Please don't sleep now. This is financial instrument. Sleeping is not allowed. Consolidated books means combination of parent and subsidiary. Now we are parent company and we have promised to buy NCI holding. NCI holding means subsidiary company shares. NCI holding means we have promised to buy S company shares from NCI people. So S company shares are also group shares. Now let me move the screen. It's like, wait. It's like, listen. This is P company, this is S company, and the combination is called group. And this is NCI people. NCI people has S company shares, and we parent company has promised that we'll buy shares from NCI, right? So if you are talking about the group point of view, so parent and subsidiary both belongs to group. So we can use the word group shares. These are the group shares. NCI has the group shares, and group shares means from consolidated point of view, it's our own shares. It means we can say it's group shares means parent company's own shares. So always remember this line. If a company has promised, listen my words, if a company has promised to buy its own shares against cash or any financial asset, you can simply write cash. If a company has promised to buy its own shares for cash, so such contractual obligation is a financial liability. So yes, it is a pure financial liability and it should be booked at 31st December X7. Don't mix it up with contingent liability. That's totally wrong. Okay, right? So it's a small part. It's like 4 marks requirement. Let me manage it for you. Read the requirement. B part. Discuss the acceptability of Fernando Company's decisions in the consolidated financial statements. Now, first part, B part 1, this is our first requirement. To disclose a contingent liability for the estimated cost of redeeming the put options, right? It's 4 marks. It's 4 marks, simple requirement. So let's elaborate. Let me show you some pointers. First of all, you will say straight away that contingent liability treatment is wrong. Contingent liability treatment is wrong. Contingent liability treatment is wrong. From group point of view, yes, we are doing consolidated financial statement. It's like buying own equity instrument for fixed amount of cash. You are buying your own, S company shares are also group shares. You are buying your own equity instruments for cash, right? So yes, it's a financial liability. So according to IS 32, it's a financial liability to be booked on present value of redemption amount. Whatever you have to pay, you need to take the present value and you have to book, right? Okay. And if you want to write more on it, then you can write extra discussion on liability sensitive board. I have told you when I teach in the class, I discuss this issue properly in financial instrument as well as IFRS 2. I say whenever there is a transaction of liability, standard board is very sensitive. Standard board is very sensitive. Why? Because in past, it happened many times by different companies. In past, it happened many times by different companies. In past, it happened many times by different companies that they tried, the directors intentionally book liability as equity to manipulate the books, to window dress the books. So that's why now standard board is very, very strict for liability. Whenever they just check the smell. If they get the smell of any cash outflow in the future, they forcefully tell you to book liability. So you can discuss that aspect as well, right? So it's a 4-mark discussion. So till now we have done 7 plus 4, like 11 marks. Now the next part, this is about compound financial instrument. This is about compound financial instrument. Okay, you need to read this heading, preference shares. This preference shares now we are going to read. Be careful, be active, not difficult at all. Just little bit of attention is required. Somewhere you have studied these things. Somewhere in your studies you have studied these things. Okay. In addition, in order, this is the new part now. In addition, in order to partly fund the purchase of the subsidiary on 1st January X7, Fernando Company issued non-redeemable preference shares and recognized them as equity instruments in the consolidated financial statement at 31st December X7. See, they have just told you that we have booked equity. You know, we are very close. Just discuss this thing. See, the directors and accountants, they really want to book liability as equity. Definitely they want to show less risk to the world. They want to hide the real risk. They want to reduce the gearing, and there are many answers and so on, right? So they are doing this. Let's see. The preference shareholder receive an annual, see, this is the clear, this annual fixed cash dividend of 5%. That's it. We have to pay 5% dividend at any cost. So it's a contractual obligation to deliver cash. It's a contractual obligation to deliver cash. That's it. It's a contractual obligation to deliver cash. So there is a for sure liabilities there, for sure contractual obligation to deliver cash. And then they are saying, and a participating dividend, which was 7% of the ordinary dividend. Yes, this thing reflects the equity thing. Participating dividends, it's like depending on the profits, and this is like an equity thing. So this is the transaction, I would say, which contains both liability and equity, but liabilities for sure, right? Then, so we call it compound or hybrid financial instrument. Let's discuss. Fernando, now see there is a game. Now they started the Fernando company stated that the instrument had characteristic of equity capital as it's provided for participation in the future income of the company. See, they are just highlighting the participating part. They are ignoring that fixed cash dividend, which is the main thing. Now, Fernando company concluded that compliance with IS 32, open your eyes. Fernando company concluded that compliance with IS 32 financial instruments presentation would be misleading, that it would conflict with the objective of financial statements set out in the conceptual framework. See, in my previous webinar, I have also discussed this, and now this is coming again. There is one paragraph in IS1. It's like running away from a standard, running away from a requirement of a standard. Wait, Fernando company considered the classification of to be equity rather than a compound. Okay. So what they are saying that we are booking it as an equity because this is very confusing stuff, and we don't want to completely apply IS 32 because there is an exemption in IS1 which says that if a requirement of standard is quite complex or misleading, or the requirement of applying that standard would misguide the users or not understandable for users, so it's better you skip that standard and you just give a disclosure on that. This is not the case. You cannot use that exemption here because for sure, with open big eyes, you can see it's a compound financial instrument. It's a compound financial instrument with a heavy duty liability. The major thing is liability because you have contractual obligation to deliver cash. Now, when I talk about compound financial instrument, one thing comes in your mind, and that is convertible loan note. Obviously, this is not convertible loan note, but hope you remember the accounting, just recalling you. Hope you remember the accounting of convertible loan note, my respected student. Convertible loan note. In convertible loan note, first of all, what we used to do, we used to treat the whole transaction as a loan, and we used to calculate the liability component. Right? And then we deduct the current value of the whole loan less the liability component. So we used to get the residue, that powder, the little area, the residue in the equity. And this also shows, even I teach this in class, that standard allowed the major portion in the liability with just the residue balance in the equity. Same is the case here. This instrument is also compound financial instrument. How? Let me explain you in clear words. And now be active, because now we won't waste time on the solution. Be smart now. Your time is important. Don't even waste times on lectures or even on my lectures. Try to watch lectures in speed. This is your art. You are getting, now the world is going towards the smartness, not time wasting stuff. No more time wasting things are required. So listen. Now what you will say, this transaction contains both equity and debt. How you will say? The debt is there because cash dividend, it's a contractual fixed cash dividend of 5%. It's a contractual obligation to deliver cash. So liability is there. And how equity? Because the participating dividend, right? So it's like profit sharing. So it's like ownership. So it contains both a debt and equity. So how you will split? You will simply write, this is not a practical question. This is the beauty of SBR. You just have to discuss theoretically. You will say that first we'll calculate the liability component using the future cash flows, right? And this liability component will definitely be a major part. And then from the current fair value of the total instrument, we'll deduct we will deduct this liability element and the residue will be your equity. Residue will be your equity, same like convertible loan notes. That's it. Done. Done. Take your time, just walk through it. Now, so how to discuss this thing? Listen, this is B. First, let's read the requirement, what they are asking. There are B part 2, it's 6 marks. To record non-redeemable preference shares as equity rather than compound financial instrument. What do you say? What do you say? Right? So you can see the requirement number B part 2 on the screen to discuss this non-redeemable stuff. So let me tell you, this is B part 2 now. Now you can see on the screen the company should have applied IS 32 on preference shares. Yes, when it is about, listen, it is about a financial liability or equity or compound financial instrument. So we all know it's about IS 32. But what the directors are trying, they are trying to avail the exemption of IS1. And what is the exemption of IS1? That if the IS is very complex and but you always remember this IS1 exemption is written, it is allowed on rare, extremely rare cases. So it's not extremely rare, it's clear-cut compound financial instrument. So when what is exemption, you say that it's very difficult and very technical and very misleading for shareholders, so let's leave it and just give a disclosure on this thing and the impact of this thing. So first of all, we would simply deny this treatment, that yes, we cannot get this exemption at all, and we have to apply IS 32. Now in IS 32 there are three major things. There are definition is written, definition of equity, the after deducting all the residue share in the assets, after deducting liabilities is your equity. Then we'll define the financial liability. It's like contractual obligation to deliver cash or any other financial asset. Then the compound financial instrument, which contains both debt and equity instruments, right? Okay. Now this is what, now I have changed the color. Can you see that I have changed the color? Now this is all application. This is all application. Now obligation, simple. In this area, there we have committed to our shareholder that yes, we'll be providing you fixed cash dividend. So obligation to transfer fixed cash dividend is a financial liability. So there is a financial liability for sure is there. So you will simply reject the treatment of equity, not at all acceptable. But this instrument also contains equity interest because holders have a right for participating dividend. So it contains both debt and equity. And yes, when it contains both debt and equity, so according to the substance of the transaction, according to even substance over form concept, you need to report it as a compound instrument, compound financial instrument. Now, how you have to report, I have already told you, just I'm repeating it. First of all, you need to calculate the carrying amount of liability using all the fixed cash stuff in which you have to pay and the present value thing, right? And then you have to deduct this present value of liability from, which is the major portion, definitely major portion. Liability is always the major portion because standard don't forgive the liability thing. Then you have to deduct this liability thing from the total fair value of this instrument. So you will, the residue, the whatever the residue will be left, it is your equity. It is your equity. Only the residue is allowed. And then you can also write this: nearly all amount of non-redeemable preference share would be treated as liability. Is the major portion. It means the major portion is a liability. Major portion is a liability, right? Okay. So this is how you need to discuss this area. You need to discuss this area of 6 marks. You need to discuss this area of 6 marks, right? I would give you 1 minute to check it out. Now only one requirement is left for statement of cash flow. Not difficult. Just a concentration is required. Just a concentration is required. So now the exhibit 3, we have to start. On 31st December, X7 looks like the last day. Fernando, the parent company, sold its entire holding in a subsidiary. It's like selling of running business. Subsidiary is your running business. And the name of the subsidiary is Interactive Company. Remember this name, Interactive Company. Fernando company had loaned $3 million to Interactive Company on 1st April X6. So it's like P2S loan, receivable for fee and payable for S company. So definitely in the consolidated books, normal consolidation, we cancel such intercompany loans. We cancel out, we eliminate such intercompany loans. This is a famous transaction. And this remained outstanding after its sale. This remained outstanding after its sale. So just think, very good type of thing. Till the date of sale, I accept it should be cancelled. But once you are sold this company, now this company does not belongs to your group. Now this company does not belongs to your group. So now it's a real receivable. So now in the consolidated books, even you have to recognize this receivable. You have to recognize this receivable because now it's outside the group. So one treatment I have told you. As a result, the loan to the former subsidiary was recorded in the consolidated financial statement at 31st December X7. Acceptable. It's okay. Now it's a real receivable. It's a real receivable. Therefore, Fernando company presented. Now there is the game changing. Wait. Therefore, the Fernando company presented the full amount of loan as cash outflow in investing activities in the consolidated statement of cash flows at that date. Now wait, this is not acceptable. This is not acceptable. Wait. You know what? First, you need to understand the investing activities. In investing activities, we record real cash flows, real. In Urdu, Hindi language, I say asli cash flow, paise ka ana aur jana. There are some students who understand Hindi. Okay. So in investing activities, we write inflows and outflows. So this is not a real outflow. This is, we gave loan like 3 years back. Just read the date. Like 1 year back or 2 years back, we gave the loan. So this is not a real cash flow. So why are you treating it as a cash flow and why are you recording it in investing activities? So first of all, this treatment is wrong. This treatment is wrong. We have not given loan today. We have not given loan today. It's not a real cash outflow, not at all. So it should not come in investing activities. Okay. Now, despite the fact there had been no cash movement on the loan during the period. So it's a non-cash movement, right? At the beginning, there is no loan, and at the year end, yes, you have recognized the loan receivable. So it's a non-cash movement. And I'm going to explain you the impact for this on gain or loss on disposal. Don't worry, I'll explain you in a minute. Now, few easy things. Investing activities, read it. Investing activities showed a cash inflow of 2 million. Why? This was made up of 10 million cash received from as a consideration from the sale of subsidiary. Yes, you sell a running business and you got 10 million cash, less 8 million paid to acquire the shares of a new. Oh, again wrong. At one end, you are selling a subsidiary, other end, you are buying a subsidiary. Both are separate transactions. Just go with basics. Listen, you have done cash you have done 3 times in your life the statement of cash SOCF topic. You have done almost in your basic F3 level, FA level, then FR level, and then here. Just think you are buying a property, plant and equipment, and you are disposing a property, plant and equipment. These two are separate transaction, and you write in a separate lines. Buying a PPE is a separate transaction. Selling or disposing a PPE is a separate transaction. So this is also separate. Buying a subsidiary is a separate transaction. Selling a subsidiary is a separate transaction. And shareholders want to know, want to see the real cash flows of both transactions. So here the netting off is not allowed. So what you should do, the 10 million is a separate inflow and 8 million is a separate outflow. Separate two you have to write. But yes, one more very easy thing, which I sometimes discuss in my introduction class. Read it. Runda company, no, this part, this is a separate. Cash and cash equivalent held by Interactive. This company, see, Interactive company at the date of disposal was 3 million. Yes. Now listen. See my bottle. Can you see this? Can you see this tumbler? Listen, let us say this is my subsidiary. And I'm selling it for $10 million. But inside this company, there is $3 million cash. Inside this tumbler, there is $3 million cash. So I sold this tumbler, I got 10 million. But yes, with this tumbler, my 3 million also went away from the consolidated books. So what is the net amount did I receive? This is 7. So yes, here 10 minus 3, 7. So we'll write a 7 million inflow. And yes, 8 million outflow. These two will be written in investing activities. Recorded in investing activities. One outflow and one inflow. Inflow in investing activities. One outflow and one inflow in investing activities. Okay. So one issue which we have to discuss is the netting off issue. Netting off of buying a subsidiary and selling a subsidiary are two transactions. I have already given you example of PPE. And the other issue which we have to discuss is the loan transaction issue. Loan issue. Okay, I'll explain both of them, each and everything. Even I have discussed the net off thing as well. Some definitions you will have to write in the examination if you want, right? Because there is a few marks for state the rule. If you want to take the picture, take it, so that I can move the screen now. Now listen, let me highlight few things. First of all, this is absolutely correct that the loan, P company gave the loan to S company. So it's receivable for P and payable for S. So it should be cancelled out in the consolidated books throughout till the date this S company was our subsidiary, right? Okay. But now once the S company left the group, so Now this loan should be booked in the P company's receivable definitely, and now it should be the part of consolidated books. In the consolidated SOFP, we should book, because now this S company is no more the part of your group. So it's an external loan you have given. It's an external loan you have given, so it should be booked, and this is written as well. It's correct, right? But the third point is incorrect. They have treated as if you have given this loan now. They have treated as if you have given this loan now, and they have booked it as an outflow in the investing activities of consolidated SOCF. This is wrong. So you will just reject it, because there is no real outflows. And in investing activities, you always write real inflows and real outflows, real inflows and real outflows, real inflows and real outflows. Okay, so you rejected it. Now one extra thing I would like to highlight. Listen, do you remember, this is extra thing. If you can't do this, still you will get marks. Don't keep a big heart. If you are giving SBR level paper, strategic level paper, you are in director room. Now don't just underestimate yourself on small issues. But I'm giving you one more point. Listen, you remember the entry for gain or loss on disposal? Sometime I teach, whenever we sell a running business, we calculate gain or loss on disposal. Like we do bank debit, we do NCI debit, we remove the NCI, we net assets of S company, we credit, right? And then we credit the goodwill. And finally we get a gain on disposal this side. If the balance is coming on credit side, it's gain, and otherwise it's loss, right? Hope you remember this entry. I always teach with double entry. This topic of selling a running business, I teach with double entry, but yes, I also teach with the statement. There are some students, they calculate gain or loss on disposal. They calculate gain or loss on disposal through statement. Okay, still you must know the maths. Now wait, whenever we need to listen to me, whenever we need to calculate gain or loss on disposal, we pick, in normally 99% questions of SBR level, we pick this net assets of S company, from S company's individual books. We pick this net assets of S company from S company's individual books. And now listen, in individual books, that loan payable is there. In individual books, they never cancel the loan payable. So in individual books, the loan payable is there. Let me listen my words. In individual books of S company, the loan payable is there. But from consolidation point of view, till the last date, this was your subsidiary. So now you need to remove that loan payable from S company books in the calculation of this net assets. So when you remove a liability, when you decrease a liability, your net assets will go up. When you remove or you decrease a liability from S company's books, so liability will go down, so automatically net assets will go up. And now listen, when this net assets will go up, ultimately your gain will be reduced. Your gain on disposal will be reduced. Think mathematically. When your net assets of S company is going up, if the net assets of S company is going up at the time of disposal of S company, then automatically the gain on disposal will go down. So you need to write in one line that this will affect your gain on disposal. And yes, wait. Hope you remember operating activities. Do you remember operating activities? In operating activities, start with PBT. If you are using indirect method, operating activities in cash flow, start with PBT. So if there is any gain on disposal, you need to subtract, you need to reverse that gain on disposal on adjustment. You need to reverse that gain on disposal from the adjustment for, if you remember, statement of cash flow rules. So just in 2 lines, you have to show this effect, that this intercompany loan will ultimately affect your net assets of S company at the date of disposal. Go slow and think, please think. This loan in the S company's individual books. This removal of loan will ultimately increase your net assets of S company at the date of disposal. And once it will increase your net assets at the date of a disposal of S company, so it will reduce your gain on disposal. And yes, gain on disposal is adjusted in operating activities of cash flow. So you just have to write that. Don't forget to adjust the gain on disposal in operating activities. That's it. That's it. That's it. That's it. The end. The end. The rest of the part I have already explained you. The netting off part I have already explained you. The 10 minus 3, 7. And yes, the 8 million I have already explained you. I have explained you. Just take your time, think over it. I'll give you some points as well. Now listen, first of all, you have to write the definition of investing activities. In investing activities, you'll buy or you record all investment cash flows. Listen to me. All investment cash flow other than cash equivalent. Cash equivalent you don't record. The movement of cash equivalent you don't record, but all other investment inflows and outflows. One more thing, like for example, like you buying a property, plant and equipment, selling a property, plant and equipment, buying a subsidiary, selling a subsidiary, all these are cash flows. And one more line you can write, in investing activities, you have to write those buying of assets, that assets will ultimately come in your balance sheet. The real assets must come in the balance sheet, right? And investing activities are reported separately. Just a question, why investing activities are reported separately? Because investing activities has a long-term impact on company. If you are doing investment right now, that means in long term you will eat fruits from that investment. So it's very important for shareholder. That's why it's a separate head. Okay. The second thing is definition of financing activities. When I teach basic student, very baby students, so I teach with this circle. Listen, there are two sources of finance. One is debt and other one is equity. One is debt and other one is equity. So, it is written and you have to write in the exam as well. What any cash flow that changes the shape, size of this financial structure, this source of finance structure that will come in the financing activities. Any cash flow that will change the shape and size of this financing structure of debt on equity will be reported in financing activities. Now, giving you example, number one, if you took additional loan, your debt will increase. So yes, it will be reported in financing activities. Hope you remember proceed from issue of loans we write. If you repay a loan, so your debt will decrease. So again, the change in the shape of this structure, it will come. If you issue new ordinary shares, so the entry will be bank debit, share capital credit, share premium credit. So definitely your equity will go up and see the shape is changing. It will be reported, right? Okay. Similarly, if you are paying ordinary dividends are paid from retained earning. And yes, retained earning is the part of equity. So by paying ordinary dividend, your equity is going down. So it also comes in financing activities. So this is the definition of financing activities, which you have to say. So this is like state the rule, the beginning part. Then you have to discuss net basis. Sometimes some cash flows can be netted off. Although this stuff which I have written, it's a boring stuff and everybody cannot write. I say it openly, everybody cannot write. And in the examination room, you are in hurry, you are in tension. So if you can't write, just enjoy your life. No tension, please. So net bases are allowed if there is one customer and some cash flows are related, inflows and outflows related to same customers, you can net off. Similarly, cash receipts and payments for which turnover is quick, amount is large, and maturity is short. Turnover is quick, like turnover means that inventory is going very fast, right? And big amounts are involved. So, in direct method, there is inflows and outflows. Hope you remember the direct method accounting, which is inflows and outflows. So it's difficult to now report everything separately. It will be too much for shareholders, So here netting off is allowed. One more thing where netting off is allowed, in the same subsidiary. Listen, my example I have already given you. If you are buying a subsidiary, just think this tumbler is a subsidiary. If you are buying a subsidiary for $10 million, and when you buy it, there is some cash inside this subsidiary, so now you can net it off, right? From consolidated point of view, you are getting a net amount. And if you are selling a subsidiary, and that subsidiary contains some cash and cash equivalent, then you can net off only one single subsidiary, right? You cannot do this, that buying a subsidiary and selling a subsidiary and you can net off. No, it's like buying a property, plant and equipment and selling a property, plant and equipment. You have to report separately because shareholders want to see the impact separately. Okay. So these things you have to write. Then now it's pure application. Let me change the color. Now application proper about that consolidation stuff. First thing you will say that cancellation of receivable payable during our ownership period is perfect. Elimination of loan receivable and payable during S company's ownership time. Perfect. Okay. Then after the selling of subsidiary, once you sold the subsidiary, now that subsidiary does not belongs to your group anymore. So after selling S company, it is acceptable to book loan receivable in consolidated books. That's also perfect. But one thing is not acceptable. At all. To treat this loan receivable as an outflow in investing activities. To treat this loan receivable as an outflow of 2 million in consolidated SOCF is not acceptable. Not acceptable. Listen to me, as it's not a real cash flow. As it is not a real cash flow, so it's not acceptable. Okay. But yes, now the thing which I just taught you, this thing which I taught you, now in one line you have to write. But yes, this loan payable of S company will affect net assets of S company at the time of disposal. At the time of disposal. So it will decrease your gain on disposal. And then finally you will say that yes, the gain on disposal is reversed in operating activities. Gain, which I told you, gain on disposal should be reversed in operating activities of SOCF, consolidated SOCF, right? Then this is more than enough. Then finally, you have to write netting off an issue. Netting off not allowed for buying and selling of subsidiary. Subsidiaries. You can just net off the selling of interactive company. Remember interactive company? That 10 million minus 3. So 7 million is an inflow. 10 million is these proceeds and 3 million is the cash and cash equivalent. Don't be a kid. You guys are smart enough. You are at the end of your course. You are taking revision days. So 10 million you sold the company and 3 million was also already present in that company. So this 7 million is the net inflow, which should be reported in consolidated SOCF investing activities. And yes, buying a subsidiary company for $8 million is a separate outflow. That's it. Enjoy your life. That's it. Enjoy your life, right? So now be careful. You have to send me this question through drafting. I'm forcing you guys to send me, right? In this way, you will improve. You know, whatever results I post, these are the students, they avail the marking facility. They follow the instruction of teacher, right? Now, ending days are left. At least follow instruction now. And you can save your exam fees. Exam fees too much of ACCA. So it's better, be serious, and then the result day will be a happiest day for you, right? So if you want to note down these points, you can note down. Pause the screen as this is recorded. So you can pause the screen, note down these points, and then you can send it to me, okay? So it's time to say goodbye. Take care. Allah Hafiz.